2019, the government had expected to rake in about $10 billion or 36 trillion shillings in investments and propel Uganda into an oil producing country by 2023. Upstream and midstream projects were slated to kick off in earnest amongst the behemoth oil companies, France's Total E&P, Anglo-Irish Tullow Oil, and China's Sinopec. The gateway was closure of Tullow Oil's sale of majority stake to Total E&P and Sinopec and concluding negotiations and signing of the Host Government Agreement, or HGA. The HGA details the rights and obligations of the shareholders of the $3.5 billion or 13 trillion shillings East African crude oil pipeline from Hoima to Tanga Port in Tanzania, which will take Uganda's crude oil to the international market. According to Peter Molisa, the Legal and Corporate Affairs Director of the Uganda National Oil Company, which is mandated to handle government's commercial interests in the sector, the plan appeared clear-cut.
So as this year started, we hoped to have the key overriding target for the sector was achieving FID or final investment decision in this year for the upstream developments, Tilenga and Kingfisher, as well as the East African crude oil pipeline. Those are the two FID points, final investment decision points that we expected this year. Of course, there is so much input into developing, into getting to a final investment decision by any investor. And most of them are commercial in nature. So we had a list of commercial agreements to discuss, to close, to finish. Key ones for the pipeline, for the crude oil pipeline, included the host government agreement. We hope to conclude that one. We also hope to conclude the shareholders agreement, the transportation agreement, and a few other agreements, but these are the key ones. Unfortunately, we did not close them.
However, a row between government and the oil companies over capital gains taxes ensued, and subsequently in August led to collapse of Tullow's sales transaction, technically known as the farm down. The cash-strapped Tullow Oil, whose volatile share prices on the London Stock Exchange fell in a tailspin, was seeking to sell its majority stake in Uganda's oil fields to Total E&P and Sinopec to raise about $900 million or 3.4 trillion shillings, of which $700 million or 2.5 trillion shillings was going to be reinvested back into Uganda to finance the remaining company's 10% stake.
Some of these, of course, were not expected. We thought we would close all of them and get to FID. So in essence, this year, there has been a disappointment that we didn't achieve the final investment decision.
Pushed into a tight corner, President Museveni in October invited executives of the oil companies to set house, and both sides ceded grounds on some of the contentious issues. The contentious issues included treatment of the $185 million or 673 billion shillings tax deductible off the $617 million or 2.2 trillion shillings costs previously spent by Tullow, which Total E&P and Sinopec were supposed to inherit after the farm down. The second issue was where to domicile the holding company of the proposed East African crude oil pipeline. The oil companies were pushing for the company to be registered in the United Kingdom, but the government wanted it here where local laws would apply. The capital expenditure for developing the pipeline is about 13 trillion shillings, 70% of the money to be raised from international lenders. So the oil companies stood ground that Uganda is not tax neutral, nor is it known for project financing, and in essence, cannot attract serious international lenders. The third issue was, the oil companies wanted government to lift limit on how much costs they can recover before they start paying corporate income tax when commercial oil production starts. This meant that the more costs the oil companies file, the less taxes they will pay. Government, on the other hand, insisted that the cap on recoverable costs will not be lifted, as it seeks the oil companies to pay some taxes sooner rather than later when oil production starts, in line with the income tax amendment of 2017. Late last month, the French oil giant, Total's chief executive and board chairman, Patrick Poyan, was in Kampala, the third time this year, for a high-stakes discussion meeting with the President Museveni, during which both sides agreed to more concessions, and the move is expected to unlock final investment decision by sometime next year.
Next year, our biggest target is FID. Because as you will note, most of these projects are really interconnected. Where it is produced, it is refined, it is transported through the pipeline. So basically, we're talking about 3 projects that require upstream FID to happen. Upstream itself, the pipeline, and the refinery. So our target for next year is to ensure that we have final investment decision for upstream and the pipeline taken. And hopefully we keep on track for the refinery to also take FID towards the end of the year.
In the meantime, Ali Sekatawa, the oil sector regulator, Petroleum Authority of Uganda's Director for Legal and Corporate Affairs, told NTV they have been doing a lot of preparatory work.
Out of the 5 items for both Tirenga and, and Kingfisher, I think we've done extremely very well on the other critical fronts. The FEED for both projects, it was reviewed, and I think there's consensus at a technical level in terms of the design for the engineering and everything for the fields and the central processing facilities. All the technical studies that we had planned for this year, geophysical and related studies, were all done.
While the process of final investment decision remains in the hands of oil companies, Sekatawa said they expect better prospects in 2020.
The moment we have clarity and agreement on those items, then the project is going to be on a roller coaster, because as I indicated, all the other items that relate to the project already have been considered, and the project is technically mature.
Sekatawa also revealed that the 2 new oil companies, Nigeria's Oranto Petroleum and Australia's Ama Energy, which were licensed in 2017, have made significant grounds.
Both of them worked and completed the minimum work programs, again with this very small few items which were not completed for reasons that were clearly demonstrable, that the reasons why they could not be, like force majeure. Some of the operations could not go on because of like the weather right now in the areas of Kanyataba.
Government, through the Uganda National Oil Company, also plans to develop a 60,000 barrels per day refinery and petrochemical industrial park in Hoima, which Musisi said remains on course.
So the refinery, it's just completion of the environmental social impact assessment, and at the very best achieve FID towards the end of the year for the refinery, so that its process now starts for construction. On Kampala storage terminal, we hope we'll have construction next year, have a joint venture partner in place, start construction of the Kampala storage terminal. KIP the same, have the joint venture partner in place, start getting industries placed in the park and develop the park.
While government hopes that final investment decision can be taken sometime next year, given the president's concessions to the oil companies as a sweetener, there's a likelihood it could be extended further to sometime in 2021, more conveniently after the general elections and its aftershocks. Frederic, Musisi, NTV.